The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, everyone, and welcome to our webinar with Merchant Tech on their speculative picks for 2018, for September 2018. My name is Janelle, and before I hand over to Brandon Smith, who will be taking you through the presentation, I just want to make sure that everyone can hear me. So if you can hear me, could you please lift your digital hand? It'll be a hand icon near your name. Okay. Awesome. I see a couple of hands. Thank you. So before I hand over to Brandon, I just want to let you know that please feel free to send through your questions. However, we'll only be addressing them right at the end of the presentation. So Brandon will go through and show us his companies and explain his cases. And then once he's done, I'll take questions. All right. Brandon, over to you.
Hi, my name is Brandon Smith and I'm presenting on behalf of Merchant Tech Capital. Together with the research team, we cover a universe of approximately 50 mid and small cap stocks and have been doing so for Standard Bank for the past 5 years. Our research can be found on the Standard Bank online platform. In today's webinar, we'll be discussing our high risk, high reward picks and exploring the challenges surrounding these stocks which make them high risk. These are stocks which have been punished by the market following specific events. The expectation is that once said events have reverted, the shares are likely to experience a re-rating. The past couple of years have been particularly difficult for the South African economy, which was characterized by threats of credit downgrades and plummeting business confidence. After the election of Ramaphosa, the economy experienced a substantial increase in business confidence. However, this was short-lived as business confidence levels have returned to levels prior to the election. Consumer confidence in spending is down as indicated by recent poor retail sales figures. Trade war tensions between the USA and China have resulted in a global sell-off and subsequently a sharp depreciation of emerging market currencies. The small and mid-cap space has demonstrated weak performance relative to the all-share index over the past 12 months. Valuations have fallen dramatically as a result of the poor market sentiment. Owing to the thin analyst coverage of the small and mid-cap space, over-penalized stocks may remain below value for relatively long periods of time. This graph shows our stock universe and how the space has been impacted by the factors we just discussed. It has been a difficult time for investors within the space. However, large sell-offs and low tides give some of the better opportunities the chance to present themselves. In looking for these opportunities, we believe that by isolating the factors that have driven financial success previously and assessing the sustainability of these drivers, there is true intrinsic value to be found by investors who understand these businesses from the ground up. Our speculative picks from this mid and small cap space universe are Interwaste, Taste, Metair, Kagura M3, and EOH. Our first speculative pick is Interwaste. Interwaste offers environmentally conscious waste management solutions. Services include waste collection, management of landfills, disposal of waste, and recovery of previously worked metals. Interwaste recently released a pleasing set of interim results, which saw their waste management division grow its top line as well as profitability. Waste volumes have continued to grow and the division continued its key focus on asset optimization and improving efficiencies. The landfill management division saw revenue decrease by 11%. Uncertainty around the compliance and the validity of the site's license remains an issue for the group. Although the court ruled in February 2018 that the license is valid, this decision has been appealed by the Gauteng Department of Agriculture and Rural Development and the Department of Environmental Affairs. This uncertainty is expected to continue to hinder financial performance. However, management is confident that the appeals court will agree that the license is valid and the landfill is compliant. China has placed a ban on importing certain waste materials and slag-type material, which has disrupted the global and local recycling industry. China has plans to add 16 more items to the list by the end of 2019. The import bans have caused the stockpiling of previously exportable waste products, which has driven the value of these items down. During the year, decreases in international recyclable waste prices substantially impacted local recyclable prices and threatened the profitability of the associated waste recycling business. Despite this, the group was able to increase margins within its waste management division. Additionally, Interwaste benefits from the fact that municipal landfills are near full capacity. This somewhat ensures long-term demand for the group's services. Additionally, the DEA continues to introduce new environmental legislation, which will create additional opportunities for the group in the form of added service offerings. The Waste Management Division is expected to grow comfortably as the South African economy recovers over the medium to long term. Demand for waste management services is directly related to the South African economy's performance. What we really like about this business is the outlook for the Landfill Management Division. Municipality landfills around the country are rapidly approaching maximum capacity. Therefore, the demand for the group's landfill services is expected to increase significantly over the medium to long term. The need for the group's landfill services is inevitable. The group also controls its entire value chain, which aids its ability to effectively manage costs and improve efficiencies. The group is focused on driving returns through cost management and improving the efficiency of internal systems. Taste is our second speculative pick. Taste owns and licenses a portfolio of corporate-owned and franchise brands. The group has two divisions, namely the food and luxury goods. The food division is comprised of brands such as Starbucks, Domino's Pizzas, Zebro's, and the Fish and Chips Company. The group's brands target a range of LSMs. The group's key brands, Starbucks and Domino's Pizzas, have struggled to gain market traction, and the group hasn't seen the growth it had hoped for. However, in Domino's stores while closing non-performing Zebro's and the Fish and Chips Company stores. The franchise portion of Zebro's has been disposed of. The food division continues to make operating losses. However, as the group increases the number of Starbucks and Domino's stores while exiting non-performing stores, the profitability of the food division is expected to increase. The group, which currently owns 10 corporate Starbucks stores, is targeting 35 and needs to open 5 stores over the next couple of years in order to break even. Similarly, management is targeting 80 corporate-owned Domino's stores by 2020 and currently owns 62 Domino's stores. 13 new Domino's stores are required in order to break even. The current depressed levels of consumer spending have had a marked negative impact on the group's financial performance. However, the group is well positioned to capitalize on improving economic conditions when such improvements occur. We believe that the group has sufficient resources to achieve its store targets and to break even over the next couple of years. The quick service restaurant industry is growing significantly in South Africa, and that bodes well for Taste. Starbucks is poised for continued market penetration in Johannesburg, which has a growing middle class with relatively higher disposable income. Management has plans to sell the jewelry division during more favorable economic conditions, which will assist the funding of the rollout of stores. Although we believe the group has sufficient resources to break even over the next couple of years, if management is unable to reach its break-even point with the resources available, the share will likely become worthless. The short to medium term is expected to remain difficult for Taste, as our forecasts indicate. If we project cash flows further along into the medium term, our valuation indicates that the share is undervalued. Using a 6-year explicit period indicates that the share is undervalued with a potential upside of around 45%. However, there is significant risk associated with holding Taste shares, as if break-even cannot be achieved, the group will fail. Metair is our third speculative pick. Metair manages an international portfolio of companies that manufacture, distribute, and sell products for its energy storage and automotive component verticals, exporting to approximately 46 countries. The latest set of results speak to the group's ability to grow despite challenging economic conditions. Although we see a recovery in vehicle production, it is the group's battery operations which we are most optimistic about. We expect that this will allow the group to participate in the expected global boom of electric vehicles. The number of electric vehicles on the road is expected to reach 125 million by 2030, according to the International Energy Agency. The number of electric vehicles on the road increased by 54% to 3.1 million in 2017, which bodes well for the group. The group's partnership with MOL in Germany provides the group with ties to China's battery production powerhouse, Xiaowei. The group has the potential for a significant increase in scale as demand for vehicles
Hi, Brandon.
Although the group is heavily exposed to emerging markets and the risks associated therewith, the group's solid operations have laid the groundwork for future growth. When market conditions in South Africa and Turkey begin to improve, we expect the group to benefit significantly. Despite the group's strong fundamentals, the market is concerned over the instability in Turkey. The share is speculative because although no one can predict the outcome in Turkey with full confidence, the moment there is stability, we believe the share will be re-rated by the market, and we expect the share price to jump. Our fourth speculative pick is Kagura M3. Kagura M3 is an affordable housing developer with a business model which focuses on the full range of related disciplines, including acquisition of land, town planning, architecture, project management of civil infrastructure, services installation, and construction of homes. Additionally, Kagura develops memorial parks. Its three divisions are residential rental investment, which is a joint venture partnership which targets income yields of 10.5%, integrated residential development, which involves the construction and handing over of affordable units, and memorial parks. Kagura has shown good growth and strong demand for their services. However, a recent dispute with the city of Johannesburg has resulted in delays in the handing over of units within their flagship development, Fleurhof. The dispute is over who is required to foot the bill for the construction of a power substation, as no units can be handed over until construction of the substation has been completed. The group is only able to recognize revenue and profit once units are tenanted. Therefore, the dispute is causing delays, which is having a negative impact on revenue recognition. We anticipate that financial performance during the current year will be significantly constrained by the delays. However, once the dispute has been resolved, empty units can be tenanted and profit can be recognized. Given the capital-intensive nature of the business, there is significant risk of running into working capital restraints. However, in the event that the group encounters working capital problems, construction can be halted until there is sufficient working capital. Additionally, annuity revenue streams from the residential rental investment division helps reduce the risk of encountering working capital difficulties. Memorial Parks is highly profitable with EBIT margins in the region of 45%. The division has shown strong growth and the group has 2 more Memorial Park projects in the pipeline. However, the division has not been without challenges, which include resistance to cremation and grave recycling. Revenue is forecast to remain flat as a result of the delays due to the substation dispute. The dispute is not expected to persist, and our valuation indicates that the share is undervalued despite the dispute. The group offers a service for which there is persistently strong demand, and we believe that the group will experience comfortable growth for the foreseeable future. Modeling a conservative scenario using an explicit period of 6 years indicates that the share is undervalued with an upside of around 28%. Our last speculative pick is EOH. EOH and its subsidiaries offer a range of solutions in industry consulting, IT services, software, IT infrastructure, industrial technologies, and business process outsourcing. EOH was a market darling before the collapse of its share price in 2017. The share price has suffered as a result of allegations of corruption. However, these are currently unfounded. Significant delays in cash collection from the public sector and reduced government spending in the ICT space is adding to the group's plight. Additionally, there has been uncertainty around restructuring the group and a change in leadership. Despite this, EOH boasts excellent employee, customer, and contract retention and continues to dominate the South African ICT market. The group has one of the best track records on the JSE when it comes to paying dividends. Shareholders have enjoyed 15 years of consistent dividend growth. The sustainability of the group's business model has been called into question because of a heavy reliance on acquisitive growth and having a high PE in order to make acquisitions. However, upon making acquisitions, the group streamlines and integrates these businesses, which does lead to organic growth in future periods. That being said, the group's ability to make acquisitions which move the business forward has been consistently demonstrated. We believe that the collapse of the share price from a high of 145 Rand per share to around 40 Rand per share presents an opportunity for significant upside. This concludes our presentation, which I'd like to thank you all for joining in on. If you would like more in-depth information on any of these companies or any other companies in our coverage, you can find our reports on the Standard Bank online platform. Please refer to our disclaimer, which is on the screen currently. And these are our contact details. And if you have any questions, welcome to ask them now. Thank you.
Thank you, Brandon, and thank you, everyone. I just want to see. Okay, we've got one question from Mel Smith, and she says it's for on EOH, and she asks, is there a potential dilution of the Lebashe deal?
Yes, there is a potential dilution effect from the Lebashe deal. We actually included it in our weekly update recently, exploring the effects of the deal. I think that can also be found on the Standard Bank online platform. It's around about 10% dilution.
All right, thank you. And then Chris wants to find out, what do you say makes sense under normal market circumstances, but looking at the share prices, it sort of looks nowhere near going high. Oh, sorry, he says what you say makes sense under normal market circumstances, but looking at the share prices, it sort of looks nowhere near going higher. And I think he's just talking about your targets. I don't know if you want to add some color to or explain the reasoning behind it.
Is that for EOH or just in general?
I think just in general.
Okay, just in general.
Yeah, Chris says it's a comment in general.
Okay. It's significant. It's market sentiment driven, and what needs to happen in order for the share prices to actually climb is that each of the events which were discussed per share actually need to revert, and the expectation is that once that happens, the share price will increase. So, for example, Interwaste, once the dispute around the FG landfill has been resolved, then we expect the share price to increase thereafter.
Okay, thanks. Alan wants you to please comment on developments at Grand Parade.
I can't comment with confidence on that, unfortunately.
Okay. I don't see any other questions, Brandon. So can you just show the disclaimer just once more so that everyone has a read through. So yeah, please just to draw your attention to the disclaimer, please have a read through. And if there are any other questions, please send them through in the next minute or two, and then Brandon will take them. Brandon, can you also Mel says the weekly EOH update is not on website. Last was April 2018.
Okay.
Mel, I'm not sure if you mean the Stand Bank website or the Merchant Tech website. But I'll chat to Brandon and find out. Perhaps we can send us the latest EOH updates from your side, and then we'll have those up on the OST website. Thanks, Mel. Brandon, I don't see any other questions. So do you want to also just take us through your contact details, should anyone have any questions after this? And so everyone knows, as always, this webinar will be available, a recording of the webinar will be available on the OST website. Cool.
So we can be contacted on 021-534-1241, or you can email midcapresearch@merchanttech.co.za, or you can send to brandon@merchanttech.co.za, and I'll see to any queries or questions.
All right. Brandon, thank you very much. And everyone, thank you for joining us, and enjoy the rest of your week.
Thank you very much.
Bye.